really good friend of mine, Tim Wallen, president of MLG. Tim and I have been friends for almost 15 years through quite the organization. And of course, John Siepmann of the Siepmann family. If I could get...
Not a friend.
So I don't run marathons with you. If I could start with introductions, just background to who you are and where you came from.
Sure. I'm president and CEO of Waukesha State Bank, and I've been in that role for the last 9 years. Waukesha State Bank, many of you may be familiar with, but it's a community bank. We've got 13 locations. We'll be opening our 14th in New Berlin in June of this year. We're about $800 million in assets. Legal lending limit of a little over $20 million. On the loan side, we're primarily small business, but on the deposit side, we're primarily retail, which is a good place to be in a normal interest rate environment when you have a low cost of funds for funding yourself. We do have a significant Fannie Mae origination side, so we have a good understanding of that as well. Historically, our appetite for developing lending I would call average relative to peer and continues to be average. Our goal wasn't to be real strong in that area, and our goal wasn't to avoid that area. And the comment I made to John and a couple others was a good economic indicator perhaps is how many lawyer jokes and how many banker jokes you hear. If the economy is doing well, you should hear lots of lawyer jokes and not very many banker jokes. And so the more lawyer jokes you start to hear again, hopefully that's an indicator from that standpoint. And I've got a little bit of a development understanding from a personal standpoint too. Starting in the mid-90s, I spent a little over 10 years on the Plan Commission in the town of Genesee where I live.
Thank you.
Matt Neumann from Neumann Companies. It's nice to see a lot of friendly faces here. I've worked with a lot of you over the years. Our business really comprises of three major functions. One, we have a partner home building company, Tim O'Brien Homes. Tim's not here today, but I'm sure many of you know him. Our land development entity is really Neumann Companies because we have a series of LLCs that do projects in various locations. And then we have a solar development company, which we really started in 2009, sort of as a distraction to get our minds out of some of the things that we were all dealing with at that point. In any case, where we're at today, we're primarily a land development operation that also provides lots for other builders. We developed in the last, I've been doing this 8 years, so I kind of came in at the peak of this when we were all having a lot of fun and got to ride it right off the cliff with everyone. So that was pretty entertaining. Learned a lot more in the downturn than I did in 04 and 05 and 06. But we developed in the last, since I've been doing this, a little over 2,000 lots, permanently preserved about 1,500 acres of green space, and built about 20 miles of road in about 25 or so different communities. So it's been a really good experience. But it's been a lot to learn here in the last 6 years and what to do, and it's going to be really interesting going forward, going back into entitlement, and I'm sure that's the kind of stuff we'll start talking about here, but it's going to be an interesting world in the next 5 years, that's for sure.
Thanks, man. Tim?
Yeah, I'm Tim Wallen. I'm an old Price Waterhouse kind of guy. I joined MLG back in 1989. They were my client. Been with them for 23 years. Took over the leadership role back in the year 2000. Many of you know my partner Mike Mooney very well. But we have a variety of things that we've done over the years. You see our commercial brokerage operation all over town, property management. Some things you don't see of us, we have a capital group. We buy properties with investors all over the country, and I've overseen that group for years. But in our land side, we've done over 6,000 acres of land development in the state of Wisconsin, 19 business projects, about $600 million in tax base on those various projects. On the residential side, we've done roughly 3,500 residential units over the years. I've been very active in that part of the business, whether on the operational side or the financial side, development side. But obviously this cycle's been about humility. We've all, in the room, we've all had some pain in this cycle, and we're all here to figure out, what does the future look like. But we learn from that. Look at the world differently. I look at the world very differently. When you had the gun and staring down your head of these issues and sales stop like that, and you're like, wow, what have I got myself into? So there's a lot of humble pie in that, but we're very thankful to work through this cycle. We've had many good partners that we managed through the cycle together, and we look forward to the future. I think the world will be different. I think going forward, you're going to see You know, just a lot more partnerships with people on the table here. It's going to be done differently just because of this. I know the bankers will look at it differently, we look at it differently. So I'm going to look forward to this conversation today and want to be interactive, ask questions, and hopefully we can all learn from it.
All right. We used to be a land developer, just like many of you in the room. We hope to get back into it. So, you guys covered pretty much everything. I don't really have much else to say other than we've been in business for 70 years this year, and we hope to be continuing that for a long time in the future. We have developed numerous subdivisions in the area, preserved lots of open spaces, and we look forward to doing more of that. So, I guess this is really fascinating to see this many people in the room. Everybody's commented on that, but we really don't get to see all of the different aspects of our industry in a meeting setting very often. So thank you for coming. I think this is great.
Thanks, Jim. You are a friend. Like the group here has mentioned, this should be somewhat free-flowing, but from a panel perspective, we have lots of stuff to talk about. We certainly have challenges with municipalities and existing impact fees that were developed 10 years ago when developing was a boom. We have problems with lenders being able to finance through regulations, so you're having to go to investor financing. But panel, what is your overall assessment of lot inventory in southeastern Wisconsin?
I guess I can start. In bad areas, it's really good, and in good areas, it's really bad. Generally speaking. Now, I guess what I would say is they're in the A market locations, which we all kind of know it's basically as close in as you can get without being too close, where taxes are a lot higher and school districts probably aren't as well regarded. Those areas, I think lot inventory is dwindling. I think the lots that are available at this point typically have some challenges with them, and that's probably why they're available. The pricing at this point has all been pretty much adjusted for what we've dealt with the last 6 years. So the good inventory, I think, has been primarily picked over at this point. If you go out to some of the B or C areas where you're maybe 30, 40 minutes from Milwaukee, there's still a lot of inventory out there, and it's going to take a long time because there's basically no volume getting built in those communities. We were fortunate to have learned that lesson only in one location, thank goodness. But we'll have inventory there for probably the rest of my career, and I think I got a few years left. So, you know, that's kind of the way it is, but I think that the first development, the first entitlement work that, you know, we as developers are going to be doing is going to be in the A locations, because it's really the only place that any of us and our banks trust to go into to start moving dirt again. So that would be my take on it.
That was a great answer. Any additional comments on that topic?
A little bit. You know, we do some internal stuff, and my guys told me to be careful sharing the data, but also be careful sharing the data. But it's not perfect, but it gives you a sense of what's going on. You know, we track inventory, and we view that there's roughly 4,000 lots in the whole 7-county area, and roughly 500 lots sold last year. So the good news is inventory is going down if you own land. And at some point you want the inventory gone so prices go back up, so you get pricing power again. You as builders want pricing power, and when right now the customer is so trained to get the discount and get the deal, and it's so hard to his mentality. One of the problems with development is, you know, the reality is you might have thought developers were charging this money to make all this money, be really super rich, but the reality is we're selling prices of what we needed to make a profit. And it was driven, a lot of the retail prices that they went to is because raw land prices went up, costs went up, and you need this high price. Well, now all of a sudden, all this inventory came on, it was discounted because of the weak market. Now customers used to lower prices, but it's still a monster gap. You take like a Franklin market, which is a great market. You know, retail prices dropped down to the mid-80s. You know, to produce new, you still probably need it to produce new, the 125. You know, to produce new. So is the customer going to pay that? So you as a developer or a builder who is going to build a subdivision, do you have the intestinal fortitude to step up and put that money into the ground? Now Franklin's a market that's extremely strong, right, and very well. And so, you know, part of the concept which Matt made reference to is there's kind of the haves and have-nots. There's markets that are really burned through the inventory and gotten very healthy and are ripe for the possibility, consideration, new construction, new development. And there's markets that look like, you said you might be on that land for 20 years, well, it looks like it's never going to come back. My gut says some of those slower markets, if you get out to a Jackson or a Johnson Creek where there's maybe 150, 200 lots available and it's selling 3 or 4 lots in a year, that's kind of tough, you know, if you own that stuff. But at some point, I think the psychology changed. I think the customers are, you know, frankly, it's been tougher to borrow money. To take the risk of new construction. Customers have been scared to do that. So, you know, I think things will get better. It all seems to, even when things are dark, things get better. And I think the market is turning. I think the psychology of the customers improving. I think the psychology of the lenders are improving. But it's going to be very slow and cautious. And you know, Matt mentioned it's just going to the best locations. That's true. That's where it's going to happen first. The question is, how fast will that happen? You know, at some point, we're going to run out of lots, and that's got to be a concern of everybody at this table here. You know, what do? You know, we're running out of lots, and how are you going to fill that gap? And from a high-level perspective, it's going to take a lot of creativity. It's going to take partnerships between investors, builders, developers. We're going to have to work together because you're going to have to redevelop the model in which it's done. Because the way it's done the last 10 years or 15 years probably is not going to work at least the next 5 or 7 or 8 years. So it's going to take a lot of creativity and a new mindset as far as you approach it.
I'd say a little over a year ago, Scott Matthey and I and several of you in the room sat down with some communities in the southeastern Wisconsin area, and that was the first time I've ever been at the table where the communities actually said to us, what can we do to encourage development? So we've had a complete turnabout in the political field here, not everywhere, but you're going to start seeing that communities are really getting hungry for fees. They haven't been generating new tax revenues. Tax revenues have been going down because the values of homes have been going down. So with all of that, it's become very expensive to live in those communities. The only way to relieve that is to increase the number of building permits. So that was a really encouraging sign, and we're hoping that we're planting a few seeds here that are going to grow. But the communities can't grow unless there's a market. So obviously we have to get through that issue. And that's where if you notice, I don't know how many of you have that graph, but this is kind of the tale of the day. This shows lot inventory, or these are permits versus new lots platted in the 4-county area. Waukesha, Milwaukee, Washington, and Ozaukee counties. You can see we have a permit number that's starting to trend upward. That's the first time we've seen that since 2003. And that's a good sign. The bad news is the downward trend in number of lots being platted is pretty much cratered. I don't know how much lower we can get. So that's what we're here to talk about today. And I think you'll find that you've got several of us up here that are chomping at the bit to get new developments online, but the lead time to get those things on the market is sometimes so long that you never get it out when you really want to. So we're at a point right now where a couple of years ago, this might be the first thing I've ever predicted that ever came true, that we would be sitting here talking about a lot shortage. And we really, truly are. And in good areas, we are. And so it's an important thing to think about.
And I'm going to go through something, but Waukesha State Bank does most of its lending in Waukesha County. I know there's stronger and weaker areas in the county, but when Scott called me and asked me to speak, my first response was, what lot shortage? So that gives you my perspective on it. Now, knowing what I know about how long the development process takes, there's no doubt in my mind that at some point we're going to see an inflection, and a hard inflection, to where there really is a shortage. But from our perspective, and I made a point after I talked to Scott to talk to head of our residential mortgage lending, for example, to get her perspective on what we're seeing appraisals for construction loans. And yeah, we don't see it yet, even though you tell me that you're seeing it in the better areas of Waukesha County, for example.
That probably can lead into some banking questions for you, Ty. I'll throw out 3 questions for you, and you can hit whatever you want to. Status of banking regulators and what impact it has on lending. How are you evaluating loans today? Is there a change from how you used to do it? And what are the parameters that you would consider financing a subdivision? Do you have any appetites for subdivision development, or do you know of any banks that do?
Those are long questions. It'll take a while.
Hit whatever you think is pertinent. We have a lot to cover.
Okay, status of banking regulations. In my mind, I could divide that into two sides. You've got the business side, lending to developers and builders, and then you've got the end user side, the consumers and the buyers. On the builder side, and I'm assuming that you'll be interested in both sides. On the business side, or the B2B side, to be trendy, it's a lot more subtle from our perspective. You can't point to a bunch of regulations that, at least as I see it, that are causing a lot of havoc. There is a lot of attention on how to deal with borrowers that are struggling, and our hands are very much tied compared to how they might have been in the 80s or early 90s. All sorts of rules of what we can and cannot do that don't necessarily make sense. But it's hard to point to any specific thing. And one of the reasons for that is there's so much ambiguity into the process. So they'll tell you that you need to classify your troubled debt restructuring, but they won't tell you what cash flow coverage ratio makes something a TDR and what does not. And so then you always have the second guessing, and if you guess wrong, they don't like that. The other thing I've kind of noticed is they're fine with something until they're not. And so for many, many years, it was okay to lend on vacant land and not have an amortization, and all of a sudden, that was anathema to them. And the more honest regulators would say, yeah, I had no problem with this type of loan 3 or 4 years ago, but other people would be telling